Does this sell-off spell trouble for the tech trade? Let's bring in Charles Schwab's chief investment strategist, Ann Sonders. Ann, what is sparking this rotation out of tech, and how severe is it looking?
You know, it's always hard, Sarah, to point to anything specific. Always valuation chatter when you talk about tech. A bit of a rotation trade, not so dissimilar to what we saw in the early stages of the downturn that began in mid-February, where the profit taking was greater in areas where there had been profits. You've got a month so far where the winners were the decided losers in the first 7 months of the year. You're seeing that at the sector level. You're seeing that at the factor level. There was the report out of MIT that renewed concerns about whether maybe the AI spend had gone beyond what the benefits will accrue based on that. So I think it's a confluence of factors.
I guess the question is, we've seen it before, as you noted, and the move was to buy a lot of these stocks down because they've made new highs. Would you recommend investors do that again?
Well, it depends on the stocks, and I don't cover individual stocks. I think the buy the dip mentality still exists, but we may not have seen sufficient amount of downside in some of these cohorts. What's also been the case is that there's been a lower quality bias to what has done well more broadly since the intraday lows on April 9th. You see baskets like the meme stocks and non-profitable tech and heavily shorted stocks really were the power drivers on the way up. And I think that kind of low quality trade got a little bit exhausted, and you've seen some renewed weakness there. But also, again, when any kind of profit taking kicks in, there's that look toward what has generated the largest profits. And you have a day like today where equal weight is up by 0.5 percentage point. S&P cap weight is down by 0.5 percentage point. I think this recent rotation is likely to persist a bit longer. You know, exactly how long, I don't know. But I think this rotation has legs.
Well, it's notable, the strength we're seeing today in consumer staple names, healthcare, I mean, some of the defensive groups, but also energy is doing well. I guess, what does it tell you? Everybody's been waiting for the rally to broaden out. I don't know. Is that what's really happening?
I think that's what's happening. That was similar, although at the index level, more to the downside in that mid-February to early April period of time, where the indexes suffered more by virtue of the mega cap names being under greater pressure than the rest of the index. We have a little bit of that right now. We just kicked in this rotation phase, and there just was a shift, again, not just at the sector level, but the factor level, momentum taking it on the chin relative to other factor areas like low volatility, higher dividend yield, value performing better. So it's hard to pinpoint what the trigger was, but you got this desire, at least on the part of traders, to maybe take some profits down the quality spectrum and move into this combination of defense and maybe up quality, certainly from a value perspective.
So is your recommendation still around quality instead of sector specific or group specific?
We're still sector neutral and recommending you stay up in quality at the factor level. So to use trader lingo, we've been saying fade the lower quality areas like non-profitable tech and the zombie companies and meme stock type trades, and lean into higher quality where you do get that ballast as you go through this period of rotation. And that's where leadership tends to find itself again. And that can span across sectors. That's the beauty of factor-based analysis or screening, is you're not limited to any particular sector. You can find value in areas like tech. You can find growth in areas like utilities. Taking that factor approach sort of widens the lens, but that's also where performance has been more consistent.
What are the key quality factors that you're looking for right now?
Strength of balance sheet continues to be one. Interest coverage, I think one particular one that's relevant to the current times is stability in profit margins, visibility in terms of forward earnings adjustments to the upside. And then for more, yield-oriented investors, dividend yield is coming back into favor. The low volatility factor is one we've liked this year, with the proviso that that's going to be an underperforming factor when you get into these sort of rip higher rallies, but it does represent some ballast if you go through a bit of a pullback phase.